Joining me now is Michael Schumacher, head of macro strategy at Wells Fargo. A nice counterpoint, Michael, to the argument we heard yesterday from Brian Weinstein, I should say, at Morgan Stanley, who thinks that yields could go still much higher from here.
Yeah, it's interesting, Kelly. Yields have already gone up a ton. We've seen that. And yet we call it a turning point. So it's the Fed, it's the European Central Bank, Bank of England. All these central banks are either done or very close to done hiking. And when that happens, markets typically rally. That's bond markets. So you typically have yields go down quite a bit pretty quickly, and markets get ahead of that first rate cut. So we do think there's quite a bit of room for yields to fall by year end.
His argument was that if the Fed cut rates by a full percentage point, the curve should steepen and the 10-year could still end up yielding more than it does now.
That's an interesting argument. I don't buy it. When the Fed eventually does come in to cut, unless something breaks badly, probably goes 50 basis points, maybe it goes a bit more. But when you think about the huge downward pressure a big cut like that would signal, I think people would grab for whatever yield they could get. So 4.30 today or 4.29 something, whatever it was, that's going to look PG, in my terms, pretty good for anybody who's buying bonds given a 100 basis point rate cut.
I've also heard, and again, we're dwelling specifically on the longer end of the curve. Everyone kind of seems to agree the short end is a nice buy. But I've heard big investors like Stan Druckenmiller say, why shouldn't we see the long end continue to normalize by historical levels? And he's talking about something maybe upwards of 5, 6, or 7%.
That's pretty steamy. And I think you have to ask yourself, from the standpoint of the U.S. government and the government budget deficit, could it really tolerate something like 6, 7% on the 10-year? That's a budget record. So from our perspective, we think the answer is no. And also think about all those investors globally who look around and say, oh, wow, these yields are pretty good in the U.S., stand out as being a really good opportunity even after adjusting for inflation. So whether it's foreign investors or U.S. domestics, I think they would really put a stop to that pretty quickly.
So and how much, not to get too wonky about it, but how much do you think what's going on, say, in Japan is driving where 10-year yields go from here?
I think it's making people wonder, Kelly, because the Bank of Japan has been a bastion of super easy policy now for decades. The messaging has been a little bit tough to interpret, let's say, over the last couple months, but people are at least getting the hint, hey, maybe the Bank of Japan will actually let rates rise a bit more on the long end, and maybe one fine day think about a rate hike. If that happened, it would send shudders to the bond market, but at least in our view, we think that's quite a ways off, but it does inject volatility. There's no doubt about that.
All right, maybe a buying opportunity. So, you're talking about buying and selling with bonds, so it's a little confusing, but your call is clear, Michael. Your explanation is as well. Thanks for joining us today. We appreciate it.
Thank you, Kelly.
Michael Schumacher with Wells Fargo.